Hey everybody, welcome to another segment of Accounting Imbalances How Do I series. In this segment, we get to talk about how do I calculate diluted EPS with different types of convertible securities. As a quick refresher, basic EPS has to be reported by every corporation out there. It has to show up at the bottom of their income statement and be rounded to 2 decimal places. And it's a measure of how much the company made for each share of ownership stock. Common stock with voting rights. Diluted EPS is a what if. It's not real, it didn't happen, but if all the people who had the right to buy shares of stock without the board's approval or additional approval, since they approved the initial securities that are out there, went ahead and purchased the stock they could, what would happen to our EPS? Now, we've already done an example in a previous week doing stock options. I don't want to talk about that again. Instead, what we want to talk about this time is how we calculate the adjustment for convertible preferred stock and convertible debt. And we'll use bonds as an example, but any kind of debt would work the same way. Let's take a look. Let's assume that Cougar Company reported basic earnings per share for the year of $1.87. They had their numerator, this is their net income minus any preferred stock dividends, of $2,973,750. And then we divide that by their weighted average shares of common stock outstanding, in this case 1,592,500. But that's not the whole story. In addition to this basic EPS information, they also had a set of preferred stock that was convertible. 97,500 shares of $100, 10% preferred stock. And each of those shares of preferred stock can be converted into 8 shares of Cougar's $10 par value common stock. So at any time during this year, those owners of this preferred stock could have swapped their preferred stock for common stock. In addition, they had $2,440,000 worth of $1,000 convertible bonds that were outstanding at the end of the year. The book value of these annual bonds, meaning they pay interest once a year, at the beginning of the year was $2,268,625. So these bonds had originally been issued at a discount, and we have to amortize that discount away each period until they get to that final payment and pay $2,440,000. The bonds have a stated rate of 6%, an effective rate of 7%, that's why we have that discount, and each $1,000 bond can be converted into 20 shares of the common stock. Marginal tax rate for the year is 30%. We want to know what diluted EPS would be based on these 2 convertible securities. We're going to start with our current values, and then we'll add in the values of the preferred stock and the bond. So our numerator currently is $2,973,750, and our denominator is $1,592,500. So that's where I'm at right now. Now let's figure out if we should add in this preferred stock or this bond. Let's start with the preferred stock. So my numerator effect, if these preferred stock shares were converted into common stock, I would not have to pay them their dividend. So I'm going to calculate the amount of my dividend, and I do that by taking the number of shares, which was 97,500. I'm going to multiply by their par value, which is 100. And then I'm going to multiply by their dividend rate, which is the amount we have to pay them each year, which is 10%. And if I multiply that, 97,500 times $100 times 10%, we're going to save $97,500. Now, I'm not going to put that up into row 15, not yet, because I'm still not sure if this is dilutive or anti-dilutive. So we'll just leave that there for now. Now let's figure out the denominator effect. And the way we do that is we take the number of shares and the common stock per share. So in this case, again, we've got the 97,500 shares Each of those converts into 8 shares. This is my dividend saved. And these are the shares issued. Now I've got my numerator effect and my denominator effect. I can get a relative EPS effect. And the way I do that is I take that numerator effect divided by my 780. Now let's do the same thing with the bond. It's the exact same process, maybe a little bit more involved though. So let's start with the numerator effect. So the numerator effect is probably the most interesting part of this. We have to calculate what we'd save in our numerator. So that's net income minus preferred stock dividend. So with the preferred stock, it was easy. The preferred stock dividend was a simple calculation. In order to figure out the effect of the bond, I have to figure out interest expense. And interest expense on a bond is the book value times the effective rate. We were told that the book value was $22,686.25 and our effective rate is 7%. Notice I'm not using the face value, $2,440,000, or the 6%. That's how I calculate the cash that is paid. But the interest expense on my income statement will include not just the cash paid, but also the amortization of that original discount that's having it show up on my books at $2,268,000 instead of the $2,440,000. So I have to be a little careful there. So let's see. If I multiply these, I get interest expense. But that's not the net income effect. That's just interest expense. Because in addition to changing interest, if I were to not show interest expense, I would also not get a tax break. In this case, I'm going to multiply by my tax rate, which is 30%. This is the tax increase. So what we're saying here is that net income would increase $159,000 because we don't have to pay interest expense. But without the interest as a tax deduction, my tax expense would go up by about $48,000. And if my income tax expense goes up, then net income goes down. So my net interest savings would be the 158 minus 47. So overall, I wouldn't get to save the whole 159. Instead, I would save 111. Next, I need to figure out my denominator effect. And we're going to start with my number of bonds. And we had bonds with a face value of $2,440,000. And they were in $1,000 increments. So I actually have 2,440 bonds. Common stock per bond, we're told, is 20. So I'm going to just copy this down. It's the exact same equation. So I will issue 48,800 shares and save $111,163. So let's get a relative EPS effect. There we go. And I'm going to take that 111,163 that we would have as an increase to net income, divide by the new number of shares, and that gives me an EPS effect of 2.28. So now what do? Well, we're only going to put in those that are dilutive. So if we go back here, our original EPS was $1.87. Looks like the preferred stock would drop it because it's dilutive. It's $1.25. That's less than the $1.87. But the bonds would be anti-dilutive. It's bigger than the 187. So if I were to put this into my equation, I would end up with a bigger earnings per share. So I won't include that one. It's anti-dilutive. Let me show you that. Let's link these in. So preferred stock is 975. Shares issued is 780. Bond is 111,163. And the shares issued 48.8. My updated values, you can use a sum too if you'd prefer. Matter of fact, I'll do that here. There we go. So my diluted EPS would be this number, That number would be $1.68. Now that is diluted. It is less than the $1.87 that we showed before. Yep, diluted, great, let's move on with our lives. Except that's not the worst case scenario, and we want diluted EPS to be the worst case scenario. Watch what happens if I get rid of the preferred stock. Notice that's a penny more than my basic EPS, $1.88 instead of $1.87. Why? Because removing the bonds is anti-dilutive. Let's put the preferred stock back in. Now let's get rid of the bond. Remember that diluted EPS is $1.68. With both of them, if I get rid of the bond, it's $1.66. So I would not include the bond in my calculations. I would leave it with just the preferred stock so that it's diluted EPS, my worst case scenario. We keep adding in these effects until the next one raises the value, and then I stop. And that's how I calculate diluted EPS. Hope that helps with what is a very important process, since this is a very important number in the financial statements of most companies. As always, we have more exciting topics coming up. We'll see you then. Thanks.